All right, everybody, another video today on a Canadian bank. I did say that I would go over a couple of them this week, and based on the comments, CIBC was definitely the most popular one, and I believe the reasoning for this is primarily due to its large run-up in 2023, 2024, and the amount of pressure it's facing right now to the downside. It's been one of the weakest performing Canadian banks over the last 3 or 4 months right now, so a lot of people are wondering if there's potentially cause for concern. So in this video, I'm going to dig through the company's earnings. I'm going to go over provisions, earnings, mortgage exposure, things like that. One thing I will say before I start, I do have a free ETF report on what I do believe is one of the strongest ETFs in the country. I'm going to drop that in the description below. You can grab it absolutely free. And as always, everybody, like the video and subscribe to the channel. So when we look to CIBC on a estimates front, the company actually did come in ahead of expectations. So we got $2.20 in earnings versus $1.98 expected, and revenue of $7.28 came in about 6% higher than expectations. However, the company's stock price is under a bit of pressure over the last 3 months. You can see losses of 6.23% versus losses of around 3% for the index. And we can really see that in late January, the stock started to take a bit of a dip and then dipped again post earnings. So CIBC has had a huge run over the last while. It's been one of the best performing Canadian banks, not necessarily due to stronger operations, but just due to provisions for credit losses, ultimately lower provisions that are kind of giving a better forward outlook from the bank. However, they did get into a bit of an issue in terms of rising provisions this quarter, and there might be a bit of uncertainty now that they're going to continue to increase. So when we look to results on the year, we're looking at adjusted earnings up 22% year over year. Again, a lot of that is due to those provisions, and we're looking at pre-tax, pre-provision income that is up 19% year over year. You're going to see PPPT in all of these banks' reports. So effectively what they look to do here is isolate provisions for credit losses out of the results to give you a better understanding of the underlying business and how it's growing, because although provisions aren't necessarily one-time expenses, they can probably be seen as expenses that are going to vary in nature, so they do like to isolate those out. Now, a lot of people will believe that this is a way to kind of isolate out bad environments when provisions are high. But the thing about it is, when a lot of these banks were reporting recoveries in provisions post-COVID, those would be isolated too, so it works both ways. This is a metric that the banks have used for a very long time. It's a good barometer of underlying company growth, and ultimately CIBC is doing quite well. So revenue up 17% as well year over year, and their CET1 is up 50 basis points year over year, well above regulatory requirements. No worries about that. So if we come down to the overall company results on the quarter, we are seeing revenue 17% year over year. We're looking at trading revenue up 27% year over year. We're looking at pre-tax, pre-provision income up 19%. Provisions for credit losses are down 2% year over year. However, this is a number I'm going to talk about a bit. They're up 37% quarter over quarter. And when we look to expenses, we're looking at 17% year over year growth in revenue, but we're looking at 15% growth in year over year expenses. And when we come down to earnings per share, we're seeing $2.20. That is year over year growth of 22%. Now, the efficiency ratio dropped. It's dropped on a quarter over quarter basis and a year over year basis. So when we think of the efficiency ratio, it is effectively comparing the operating expenses of the bank to revenue. So what a 53.1% efficiency ratio is saying, for every dollar that CIBC generates in revenue, 53.1 cents of it goes to operating expenses. This efficiency ratio is actually relatively strong. I mean, we're seeing many banks like Toronto Dominion that's approaching the high 50% range. And what you'll typically see, these banks report better efficiency ratios in Canada than they do in the United States. And with CIBC being a very Canadian heavy bank, this isn't really all that surprising. We're looking at return on equity 15.3%. This is actually up quite a bit. Obviously, the company's had a pretty good run in terms of results over the last while. So when we go to its Canadian end, we can see that the Canadian end of the business is actually doing quite well. I mean, we're looking at 9% year-over-year growth in revenue. We're looking at, relatively stable provisions for credit losses on a year-over-year basis, but again, big spike in quarter-over-quarter, which I'll talk about in a bit. Net income obviously has declined 3%. Primarily, a lot of that is due to these higher added expenses, things like that. And if we look to the loan growth and deposit growth, this is a bit concerning. I guess I was looking at reported numbers. I should look at adjusted, although they're all relatively the same. When we look to loans and deposits, we're looking at only 2% growth in the Canadian arm of the business. When we look to a bank like Royal, they're often growing deposits and loans by mid-single digits. I actually think deposits actually went up by 8% or something like that with Royal Bank. So there's definitely a bit of a slowdown in this regard. And when we go to commercial banking and wealth management, obviously this is going to be much the same as any other institution. They're seeing big growth in assets under management. They're seeing big growth in revenue. They're seeing big growth in overall earnings, 13% growth in earnings. If we think about this, especially on the wealth management arm, this isn't really all that surprising considering the state of the equity markets. When we look to their U.S. commercial banking, much the same. We're looking at double-digit year-over-year growth in revenue. We're looking at a big jump in net income. That is primarily because of a huge decrease in overall provisions for credit losses in this area. We're looking at assets under management up 11%, so they're doing pretty good in this regard as well. Capital markets, again, I'm not going to go over this too much because of the big increase in the markets. I mean, they're going to do very well in that area when the equity markets are hot. One thing I do want to speak on is the allowance for credit losses. And the one thing I want to talk about is actually the differences between provisions and allowances, because this is a very misunderstood aspect of banks. It is something that people need to understand because it is probably one of the most important key performance indicators for banks, especially during times of economic weakness. So with allowance for credit losses, effectively, you can think of allowance for credit losses as a piggy bank. And you can think of provisions for credit losses as being the money that you're putting in that piggy bank. So for this reason, the allowance for credit losses you will find on the balance sheet. It's a balance sheet item. It is effectively a cumulative amount of money they've set aside for credit losses. So when we think of provisions for credit losses, those are on the income statement. They come out of net income, or in the case of a recovery, they can be added back into net income. So when we look to CIBC over the last while from a provision for credit loss basis, we can begin to see why the bank did so well in 2024. When we looked at provisions in 2023 and 2022, we saw a huge spike accelerating quarter after quarter after quarter. And then it looks to be like the company might have been a bit too overzealous when it comes to reporting provisions. So we started to see big declines. So we look at October of 2022, 530 million. We look at October of 2023, 541 million. It's a pretty good sign. Obviously, January 2024, this was still well above 2023 numbers, but then we start to see 3 straight quarters of declines. And if we go back to CIBC's stock price throughout 2024, it's going to give you a very good idea of why this company did so well. So we're going to go to December 31st, 2024, and we can see the company returned 42%. That was before dividends. If we total return this out, we're looking at nearly 50%. I do believe it was the best performing bank in Canada. And a lot of this was due to these lower provisions. And as provisions get lower, obviously allowances get lower. Now, when we go on FinChat here, allowances are a negative item, obviously, because they are a negative amount on the balance sheet. So we're looking at 2021, 2022, 2023, big spikes. And then here things start to normalize, which is ultimately what the market wants to see. We're talking about, 2023, 2024, we're fairly normal. And then the last 12 months would just include this recent quarter. And we're starting to see an uptick again. So the market probably didn't like that. And if we do go to the overall PCLs here, we're going to see a bit of a spike. So last quarter, the company effectively reported 0 performing loan PCLs, which are loans that are still being paid but could default in the future. The bank feels like they might. Impaired loans are obviously they're loans that have already went through some sort of payment difficulty. So we can see throughout 2024, the bank generally improved its performing and its impaired PCL ratio, which would effectively compare these provisions to their overall loans. So they went down to about 0.3%. However, we're seeing just 1 quarter later, it jumped quite a bit. We can see performing loan PCL ratio jump by 33%, 30 basis points to 40, and we're seeing the impaired ones stayed relatively steady. However, this big increase in provisions for credit losses is probably why the bank is going through a bit of difficulty as of late. Obviously, when things are going good and those provisions are going down, the market's going to be fairly bullish, but then when you see a little quarter like this, it might spook them a bit. Obviously, we've seen this with a company like BMO. It struggled for a very long time due to rising provisions. It's actually one of the main reasons I sold the bank. And CIBC, who knows if it's going to continue, but if they do continue to accelerate, you're very likely going to see some pressure on the company's share price. And overall, if we look to the bank's total provisions, we can see that the bulk of them are in the Canadian arm. We're looking at $573 million in total provisions, 428 of them being in Canada. And if we just quickly factor in the impaired portion of it, we're looking at $307 million and $107 million. So we're looking at $414 million of $573 being impaired. So overall, the results were not that bad, although this provisional spike probably spooked a lot of people. And the other thing I do believe maybe spooked a lot of people was its mortgage data. So if we come down to its gross impaired loans and we look to Canadian residential mortgages, this is the fastest growing segment in terms of impaired loans. Now, I don't want to scare anybody. It's really, these ratios are not that bad right now, but they are accelerating, and it's definitely something that investors will want to keep an eye on. And it's actually something I'll go over in terms of particular types of mortgages, which is something I'm really keeping an eye on. But we're looking at 25 basis points in Q1 of 2024. That's risen 6 basis points to sit at 0.31%. When we look to Canadian personal lending, it's increased by about that same amount. But then when we look to business and government loans, that actually declined year over year. And in the Caribbean, it actually declined year over year as well. So when we go to the mortgages in terms of the GTA, which is one thing I do want to speak on, this is an area that I'm paying particular attention to. Now, for the most part, total mortgages, 90-day delinquency rates, as I mentioned, we're going from 25 basis points to 31 basis points. Insured mortgages, we're going from 30 to 39 basis points. So that is actually the highest portion of the bank's mortgage delinquencies right now is insured mortgages, which does provide a bit of a buffer. However, one thing I'm actually looking at is this uninsured mortgages in the GTA. So the one thing we can look to right here is loan to value, which effectively measures the value of the home to the value of the loan. So ultimately, you want to see a lower number here. It just kind of means that there's less mortgage relative to the price of the property. So we can see that the GTA is the highest loan to value for the bank. Out of all the company segments, Greater Vancouver area, Greater Toronto area, and just overall mortgages in general, the GTA represents, I guess in a quick sense, you could say the highest risk mortgages. However, a 55% loan to value on average is still very, very strong. I don't want to give the impression that all their GTA mortgages are under huge risk. But the one thing that is something investors, especially if you own this company, you need to keep a very close eye on, that is these uninsured mortgages in the Greater Toronto area. So we're looking at Q1 2024, 21 basis points. We looked at Q1 2025, it jumps to 36. This is a very, very big jump. We looked to the Greater Vancouver area, we actually saw a decline. We looked at overall uninsured mortgages, we saw a 7 basis point increase. We looked to insured mortgages, 9 basis points. But if we looked at the GTA, we're looking at a 15 basis point increase. This is not a doubling, but probably 75% increase on a year-over-year basis. When we look to tariffs overall, especially if they continue to linger, the GTA is probably going to be one of the biggest hit areas. Obviously, it's our largest city in Canada. It also has the highest amount of real estate value, which is effectively going through a massive correction right now. And overall, if tariffs continue to linger, people are renewing their mortgages at higher rates, people are losing their jobs, I could see this continue to accelerate. And although this ratio is still pretty low right now, the one thing I do want to highlight is I did a quick search, went back to pretty much the first time that I noticed CIBC started reporting this data, and it was in 2017, and this ratio sat at 7 basis points. So right now, compared to 2017, we're seeing about a 420% increase in 90-day delinquency rates in the Greater Toronto Area. So overall, this is something I think you need to keep an eye on if you are an investor in CIBC. And then again, I've often spoken about CIBC's exposure to essentially real estate lending here in Canada. I mean, when we look to it, it's got a 62% consumer loan portfolio, 51% of that to real estate secured lending. Then we look to HELOCs, 4%. So this bank does have quite possibly the most Canadian exposure when it comes to real estate. And right now, Canadian real estate is in a bit of a situation right now. Obviously, we have the GTA going through a significant correction in terms of pricing. Depending on where you live, it's getting downright nasty. But this is just something to keep an eye on, and is actually why I've never really wanted to own the bank, and probably why I never will own the bank. I just really don't like this aspect of it. They've done very well over the last year, but this is primarily due to the provisions being scaled back, and now we're seeing them tick up a bit. From a valuation basis, CIBC is fairly valued, I would say. I mean, when we look at historical averages, 10.79x earnings, and we're looking at 5-year averages of 10.99. When you looked at 10-year, we're actually looking at it trading at a premium. So is this dip an opportunity? Again, I'm going to be completely honest. I would personally say no, just because I would never hold this bank anyway. I do believe the other institutions are better performers. You know, I do acknowledge that it did have this huge run up. However, the one-off quarter of higher provisions, I mean, we'll really have to see if they continue to persist or if it was a one-off issue. I could really see this company taking a bit of an impact if we go back to 2023 when provisions were still rising, because if we look at 2023 returns, they were not very good for the bank. We can see that for the most part, it was underperforming the index up until the end of 2023 when the environment started to improve a little bit, and you can essentially directly correlate this. We're looking at October, late October. Look at what they reported in October. We're going from provisions of 736 million down to 541. I would guarantee you if this provision came in at 900 million, you would have not seen price action like this. You probably would have seen more declines. So I would pay attention to these delinquency rates. If you're a holder, I would just pay attention to the overall provisions for credit losses. Obviously, we want to own these banks for the long term, and provisions are going to be fairly rocky over the short term, but they can give you a bit of a perspective on the forward outlook of the bank. This company has a lot of Canadian exposure, and tariffs ultimately are probably going to hit this bank possibly the hardest, but it's going to hit a lot of other banks. I mean, if we think of banks with high Canadian exposure like Royal, like National, but CIBC is particularly focused on that real estate aspect of it, which is why I've never really been interested in owning it. So that's it for the video, everybody. As always, head down below, like the video, subscribe to the channel, and grab that free ETF report in the description, and I'll see you next time for more great Canadian content.